Hi, this is Elliot Eisenberg of Graphs and Laughs, here to catch you up to date on the latest in residential sales data for both Hillsborough and Pasco counties. And it continues to be a story of inventory, but one that's subtle and interesting. On one hand, inventory is up 100, 150, 175% year over year. But that's only because inventory a year ago was crazy low at 3 weeks or 3.5 weeks, whatever it was. So there's been a huge increase. Now it's 2 months or something like that. But it's still ridiculously small. Nationally, inventory is 3.3 months. Here in Tampa area, whether it's Hillsborough, Pasco, single or multi, inventory is 2.1 months. Still very low inventory. Because inventory is so low, even though interest rates have gone way up, prices continue to rise. On the single fam side, both Hillsborough and Pasco, single fam side, up about 15%. On the multi-fam side, however, in both locations, up about 30%. So where things are a little cheaper, there's a little bit more price appreciation. If we now look at other metrics, other data, sales data, it's weaker across the board, a little weaker in Hillsborough than in Pasco, again, a little more expensive. If you look at pending sales, they're down across the board with the strongest activity occurring in Pasco multifam. Again, slightly cheaper product out there. Not cheap, but cheaper. If you look at sales price to original listing price, it's certainly coming down. And prices remain strong growth because inventories, though growing, are very, very low. And I think they're done for the next couple of months. If we turn our attention now and look nationally, what do we see? GDP is improving. In Q1 and Q2, GDP was terrible, negative in both quarters. In Q3, it was positive, and Q4 is going to be positive again. So Q3 and Q4, the amount of positiveness will compensate for the decline in the first half of the year, such that the overall year is going to be pretty good growth. This is well below trend, but pretty good and a good recovery from the first part of the year. The big problem remains inflation. It's way elevated. It's much too high. But on the good news side, it's come down from the low 8s to the upper 7s. Let's cross our fingers that this continues. The Fed is certainly not convinced, and they're still going to raise rates. But they're probably going to raise rates a little bit slower at their next meeting, probably 0.5 point and not 3/4 of a point like they've raised for the last 4 meetings in a row. The fastest rate hiking cycle we've seen since the early 80s and when Paul Volcker was chair. So that's good news. The big question now is how fast inflation falls, this fast or slowly, and how low does it get? Does it get back to 2 relatively quickly, or does it stall out somewhere at 4? This remains to be seen, and the Fed will respond based on what it sees. But now there's a glimmer of good news. The Fed's going to slow down hikes, and I think early next year, by the end of first or certainly the middle of second quarter, we'll stop hiking altogether. The big fear I have going forward into 2023 is recession fear. We have an inverted yield curve, and the impacts of the rate hikes that have already taken place haven't been fully felt in the economy. Rate hikes have been going on steady since March. Now, in the housing market, they hit very fast as rates went up. But other sectors of the economy can take 6, 12, 18 months to feel the impact. So we haven't begun to feel the bulk of the impact in the bulk of the economy. That's why I'm fearful there'll be a recession in mid-2023. Keep your eyes focused on that and keep your business plan actions accordingly. All the best, and I look forward to seeing you next month.